It happened. The Federal Reserve just blinked. On December 10th, 2025, Jerome Powell and the Federal Open Market Committee cut interest rates by 25 basis points for the third consecutive time. But this was not just another rate cut. This was a surrender. The beast has lost its nerve. The hammer they used to crush the economy for 3 years has finally cracked in their hands. And what comes next is a mathematical certainty. The emergency rate cut you have been warned about is no longer speculation. It is inevitable. The labor market is collapsing. Inflation is stuck above target. The markets are pricing in chaos. And the most powerful central bank in the world has just admitted it cannot control the situation anymore. They tried to sound confident. They tried to pretend this was a measured policy adjustment. But if you read between the lines of the December statement, if you listen to the panic beneath Jerome Powell's calm tone, you will see the truth. The Federal Reserve is terrified. They're standing on the edge of a cliff, and they know that one wrong move will send the entire financial system into free fall. The window to act is closing. Within the next 6 months, possibly sooner, the Fed will be forced to call an emergency meeting outside the regular schedule. They will slash rates by 50 basis points or more in a single unscheduled move. And when that happens, the game changes forever. Let me show you why this is no longer a theory. Let me walk you through the data, the signals, and the trap that the Federal Reserve has built for itself. By the time we are done, you will understand that the emergency cut is not a question of if, it is a question of when. The first thing you need to understand is what happened on December 10th. The Federal Reserve cut rates by 25 basis points, bringing the federal funds rate to a range of 3.50% to 3.75%. This was the third cut in a row, following cuts in September and October of 2025. On the surface, this looks like a normal monetary policy adjustment. The Fed lowers rates when the economy shows weakness. This is Econ 101. But here is where it gets interesting. The vote was not unanimous. In fact, it was one of the most divided votes in Federal Reserve history. 9 members voted for the cut. But 3 members dissented. 1 member, Stephen Moran, wanted a larger cut of 50 basis points. 2 other members, Austin Goolsbee and Jeffrey Schmid, wanted to hold rates steady. This is the first time since December 2014 that 3 members have dissented in the same meeting. When was the last time the Fed was this divided? Right before the 2015 taper tantrum. Right before the market crashed. Internal division at the Fed is not a sign of healthy debate. It is a sign of panic. It means they do not know what they are doing. They are flying blind, and they are terrified of making the wrong move. Now here is the kicker. Despite cutting rates, Jerome Powell delivered what analysts are calling a hawkish cut. This is financial doublespeak, for we are cutting rates but pretending we are not worried. Powell changed the language of the statement. Previously, the Fed said it would make additional adjustments to policy. In December, they said the extent and timing of future adjustments would depend on data. This is code. It means they are no longer committed to cutting rates. They are trying to buy time. They are hoping the data improves so they do not have to cut again. But the data is not improving. It is deteriorating. And that is why the emergency cut is coming. The labor market is breaking. This is not an exaggeration. This is not fear-mongering. The numbers are screaming at us. In November 2025, the unemployment rate rose to 4.6%. This is the highest level in 4 years. It is not catastrophic yet, but it is accelerating. The economy added only 64,000 jobs in November. For context, you need about 100,000 jobs per month just to keep the unemployment rate stable. We are falling short. Private sector job creation is even worse. Only 69,000 private jobs were added in November. In October, it was 52,000. The trend is clear. Businesses have stopped hiring. They are not firing workers yet, but they are not expanding either. This is what economists call a low hire, low fire environment. It sounds stable, but it is not. It is the calm before the storm. When businesses stop hiring, it means they are bracing for a demand collapse. They are preparing for recession. Now, let me introduce you to the SOM rule. This is an economic indicator named after economist Claudia Somm. The rule states that when the unemployment rate rises by more than 0.5 percentage points from its lowest point in the past 12 months, a recession has already begun. We are currently 0.4 percentage points into that threshold. We are 0.1% away from triggering the SOM rule. One more bad jobs report and the alarm bells will be deafening. The Federal Reserve knows this. They are watching the same data we are, and they are panicking. Because if the labor market tips into recession, they will have no choice but to act. And they will not have time to wait for the next scheduled meeting. They will be forced to call an emergency rate cut. But wait, there is more. Inflation is still a problem. Core personal consumption expenditures, the Fed's preferred measure of inflation, sits at 2.8%. The Fed's target is 2%. We are 80 basis points above target. For 3 years, the Fed hiked rates to crush inflation. They told us they would do whatever it takes to bring inflation back to 2%. And now, with inflation still elevated, they are cutting rates anyway. Why? Because they are trapped. They are caught between two nightmares. If they keep rates high, the labor market collapses and triggers a recession. If they cut rates too much, inflation stays sticky or even accelerates. This is the definition of a policy failure. They hiked rates too much, too fast, and now they cannot get out of the mess they created. The inflation problem is made worse by tariffs. In 2025, the Trump administration imposed tariffs on imports, raising the effective tariff rate to around 14 to 16%. These tariffs have added 0.4 to 0.5 percentage points to core inflation. The Fed's working assumption is that tariffs are a one-time price shock. They believe that once the tariffs are fully absorbed into prices, inflation will come back down. But that assumption is fragile. If Trump escalates tariffs in 2026, which he has threatened to do, inflation will not fall. It will stay elevated or rise further, and that will force the Fed into an impossible choice. They will have to decide whether to fight inflation or save the labor market. They cannot do both. And when that moment comes, they will choose the labor market. They will cut rates aggressively, even if it means inflation stays above target, because the political cost of a recession is higher than the political cost of inflation. Now, let us talk about the succession crisis. Jerome Powell's term as Fed chair expires on May 15, 2026. That is less than 5 months away. President Trump has already signaled that he will appoint a new Fed chair in early 2026, likely in January or February. The leading candidate is Kevin Hassett, who currently serves as director of the National Economic Council. Hassett is a known dove. He has publicly advocated for lower interest rates. He believes the Fed should cut rates aggressively to support growth, even if inflation is above target. Trump has made it clear what he wants. He wants rates at 1%. He has said this publicly multiple times. He believes the Fed's job is to support the economy and the stock market, not to fight inflation. This creates a massive problem. If Hassett is appointed and confirmed, the Federal Reserve will lose its independence. Markets will assume that the Fed is now taking orders from the White House. And when that happens, long-term inflation expectations will rise. Bond investors will demand higher yields to compensate for the risk of future inflation. The 10-year Treasury yield could spike to 4.5% or higher. This would tighten financial conditions, even as the Fed is trying to ease. It would create a feedback loop where lower short-term rates lead to higher long-term rates, which defeats the purpose of the rate cuts. The Fed is walking into a credibility trap, and once they lose credibility, they lose control. Let me show you the divergence between the Fed and the market. The Fed projects only one rate cut in 2026, bringing the federal funds rate to around 3%. But the market is pricing in 2 or more cuts. Futures markets are betting that the Fed will be forced to cut rates at least twice, possibly 3 times, by the end of 2026. Who is right? The market. Because the market is forward-looking and the Fed is backward-looking. The Fed looks at current data and says everything is fine. The market looks at the trajectory of the data and says a recession is coming. History shows that when the Fed and the market diverge this much, the market wins. The Fed is forced to adjust to reality, not the other way around. And when the Fed finally admits that the labor market is deteriorating faster than expected, they will not wait for a scheduled meeting. They will call an emergency meeting and cut rates immediately. Emergency rate cuts are rare, but they are not unprecedented. The last emergency rate cut was in March 2020 during the COVID-19 pandemic. Before that, it was September 2008 during the financial crisis. Before that, it was September 2001 after the 9/11 attacks. Emergency rate cuts are reserved for moments of acute crisis. They signal that the Fed believes the economy is in grave danger, and that waiting for the next scheduled meeting would cause irreversible damage. So what would trigger an emergency cut today? There are 5 scenarios. First, a sudden spike in unemployment. If the unemployment rate jumps from 4.6% to 5% or higher in a single month, the Fed will panic. This would signal that the labor market is not just weakening, it is collapsing. Second, a credit event. If a major bank or financial institution becomes insolvent, the Fed will need to inject liquidity immediately to prevent contagion. Third, a market crash. If the stock market falls more than 20 to 30% in a short period, combined with widening credit spreads, the Fed will intervene. Fourth, a geopolitical shock. A war, a major terrorist attack, or cyber attack on critical infrastructure could trigger an emergency cut. Fifth, an unexpected recession signal. If the ISM manufacturing index falls below 45, or if initial jobless claims spike above 500,000 per week, the Fed will be forced to act. Any one of these scenarios could materialize in the next 6 months, and the probability is not low. Economists estimate that the chance of a recession in 2026 is between 30 and 42%. That is nearly a coin flip. If the recession materializes, the emergency cut will follow. Let us talk about the stock market. The S&P 500 is trading at 26 times trailing earnings. This is near the highest valuation in history. The only time it was higher was during the dot-com bubble. At these valuations, the market is pricing in perfection. It assumes that corporate earnings will grow by 10% or more every year. It assumes that the Fed will cut rates and keep financial conditions loose. It assumes that there will be no recession, no inflation surprise, no geopolitical shock. But what if any of those assumptions breaks? If earnings growth slows to 6 or 7%, which is the historical average, the market will fall by 10 to 15%. If a recession occurs and earnings decline, the market could fall by 20 to 30%. Institutional investors know this. A survey of $5 trillion in managed assets found that 79% of institutional investors expect a market correction in 2026. Nearly half expect a correction of 10 to 20%. 1/5 expect a correction of more than 20%. The smart money is already positioning for a downturn, and when the market corrects, it will force the Fed's hand. Because the Fed does not just care about inflation and unemployment, it cares about financial stability. If the stock market crashes, it will create a negative wealth effect. Consumers will feel poorer and cut spending. Businesses will see their market capitalization evaporate and stop investing. The entire economy will spiral downward, and the Fed will have no choice but to intervene with an emergency rate cut. Now let me address the elephant in the room, the yield curve. For 2 years, the yield curve was inverted. This means that short-term interest rates were higher than long-term interest rates. An inverted yield curve is one of the most reliable recession indicators. Every recession in the past 50 years has been preceded by an inverted yield curve. But in 2025, the yield curve normalized. It is now positively sloped, with short-term rates at 3.75% and long-term rates at 4.2%. Does this mean the recession risk is gone? No. It means the recession risk has shifted forward. The yield curve inverts before a recession, and then it inverts right before the recession begins. We are in that phase right now. The curve has uninverted, and the recession is coming. The Fed knows this. They are trying to get ahead of it by cutting rates preemptively, but they are too late. The damage has already been done. The lag effects of 3 years of rate hikes are still working their way through the economy. And by the time those effects fully hit, the Fed will be forced into emergency action. Let me paint the picture of what happens next. Sometime in the first half of 2026, likely between January and June, one of the 5 trigger scenarios I mentioned will occur. The unemployment rate will spike. A credit event will emerge. The stock market will crash. A geopolitical shock will hit. Or an unexpected recession signal will flash red. When that happens, the Federal Reserve will convene an emergency meeting outside the normal schedule. They will announce a rate cut of 50 basis points or more. They will say that they are acting decisively to support the economy and maintain financial stability. The market will rally initially, because investors love rate cuts. But the rally will be short-lived, because emergency rate cuts do not prevent recessions. They signal that a recession is already here, and once the market realizes that, it will sell off hard. The Fed will then be forced to cut rates again at the next scheduled meeting, and again at the meeting after that. By the end of 2026, the federal funds rate could be at 2.5% or lower, and inflation will still be above target. This is stagflation. Slow growth, high unemployment, and persistent inflation. It is the worst possible outcome for the economy. And it is the outcome the Fed has created by mismanaging policy for the past 3 years. But here is the thing. You do not have to be a victim of this. You can position yourself to profit from the chaos. If you know that an emergency rate cut is coming, you can position your portfolio accordingly. Long-duration bonds will rally when rates fall. Defensive sectors like utilities, consumer staples, and healthcare will outperform. Gold and commodities will surge as inflation expectations rise. The dollar will weaken as the Fed slashes rates. And if you are nimble, you can even profit from the market volatility by trading options or shorting overvalued stocks. The key is to act before the emergency cut happens, because once the Fed announces it, the market will reprice instantly. You will not have time to position. You need to position now, while there is still time. The signs are all there. The labor market is breaking. Inflation is stuck. The Fed is divided. The market is overvalued. The yield curve is flashing red. And Jerome Powell is running out of time. The emergency rate cut is not a conspiracy theory. It is a mathematical inevitability. The Fed is trapped. They hiked rates too much, and now they cannot get out of the mess they created. They will be forced to cut rates aggressively, even if it destroys their credibility, because the alternative is a full-blown recession and a market crash. And they cannot let that happen, not on their watch. So what do? First, educate yourself, understand the mechanics of monetary policy. Understand how rate cuts affect different asset classes. Understand the risks and the opportunities. Second, position your portfolio. Shift out of overvalued growth stocks and into defensive sectors. Add exposure to bonds, gold, and commodities. Hedge your risk with options or inverse ETFs. Third, stay informed. Monitor the labor market data. Watch the Fed statements. Pay attention to the bond market. The signals are there if you know where to look. And fourth, do not panic. Volatility creates opportunity. The traders who profit the most are the ones who remain calm and execute their strategy when everyone else is losing their minds. The emergency rate cut is coming. The Fed just blinked. And the transfer of wealth from those who are unprepared to those who saw it coming has already begun. The clock is ticking. Are you ready?